Welcome to the latest episode of Straight to Why, where we bring you the conversations and insights uncovering the why behind the people, companies, and ideas transforming our world. Today, we are thrilled to feature Cameron Dawson, Chief Investment Officer of NewEdge Wealth, where she spearheads the development of the firm's investment themes, strategies, and market views, while collaborating with the firm's advisors and clients. Cameron is a well-known voice in the financial markets, and she is credited with her deep insight and investing expertise. I'm also a fangirl. I watch everything she does on TV, and I'm really excited to have you here. So thank you so much for joining us, Cameron.
Oh, thank you, Amanda. I'm so happy to be here.
Well, we're here to talk all things markets, and it seems like the perfect time of year because we've wrapped 2025. We're into the very early stages of 2026. One of the things I thought I would start with, just to get your perspective on, is despite what was a year of tremendous uncertainty in 2025 for a host of reasons, whether it was the focus on AI CapEx, tariffs, other geopolitical events, you name it, the markets held up really well. Mm-hmm. I would love to get your view on why.
It was pretty simple, and it all comes down to growth and earnings. So if you look at forecasts for GDP growth over the course of 2025, you had a scenario where markets or forecasters were expecting kind of normal average growth at the beginning of the year. And then all of a sudden Liberation Day happened and they cut their forecasts really aggressively. And then slowly but surely, it turned out that the U.S. economy continued to prove that it was holding up better than people expected. So as we think about the lows coming off of April, the most important point is that it was really driven by this fundamental strength in the U.S. economy. And I think it speaks to the fact that we can't just talk about the U.S. economy in aggregate, which we'll get there, this idea of K-shapes and the spoils of things, whether we're looking at earnings or the consumer, for example, not necessarily consistent with different cohorts of the economy. But the reality is that we've been in an environment where we continue to surprise to the upside, whether it's on earnings growth, GDP growth, and that's a really important fundamental underpinning driver of any kind of market rally. And so I think the question as we go into 2026 is we look at those estimates, they're continuing to rise. Can they keep continuing to rise? There's a couple threads that we can pull on there, but that will be the most important kind of factor as we move through the course of the year. Ask yourself or look at different metrics to say, are earnings estimates still going up? If that's a yes, it likely means that the market can continue to press higher. If we're in an environment where people are cutting estimates because we're more uncertain about where the world is going, that'll likely be an environment that could usher in more volatility.
And what do you think about PE multiples? Do you think they're stretched?
Oh, certainly. I mean, they are stretched by any historical definition. You can look at broad measures of valuations and slice and dice it a whole bunch of different ways. And there's really no way to argue that equity multiples are cheap. The only way that you can argue it is that we're in some kind of new paradigm that justifies a much higher valuation. But history suggests that every time we try to make a new paradigm kind of argument, it typically blows up in our face. One of the most famous quotes from 1929 was Irving Fisher saying that he believed that stocks had reached a, in quote, sustainable high plateau. And we all know how that ended.
We know what happened there, yes.
And you think about what happened in the 90s. Of course, we're seeing this fantastic growth from the internet, new paradigm, valuations can move higher. Those are what we've been calling the famous last words, to quote the great My Chemical Romance song, because there's an emo kid somewhere still inside of me. But I think your point is very important, though, is that when we look at the returns for 2025, what they were driven by in the US was not valuation expansion. We started the year just as expensive as we ended it. And we think that that will be a similar characteristic to 2026, meaning there's not a lot of room for upside to valuations. Now, could we go into a real bubble scenario and things get really frothy? Yeah, sure, that could happen. Hard to make a forecast for that. Right. It's sort of like predicting an avalanche or predicting a wildfire. In a way, there's some certain kind of chaos theory that's necessary to understand when bubbles happen. But the message would be that in order to see much more upside in markets, it really has to come back to that earnings growth. That earnings will be the key driver of further upside.
It makes sense. Now, I completely agree with that. What I'm curious about is the concentration of those earnings. So when I think about 2025 and I think about 2026, we know how much money has been spent by the hyperscalers on AI and AI related data centers and infrastructure. And we have a feeling that it's a tremendous amount of capital to put forward relative to the returns that we see today. Doesn't mean that's what the future will hold. I think we said similar things about the internet. And yes, there were a lot of losers, but there were a handful of really, really big winners. And I think the same could prove to be true for AI. It's just the question of chaos between here and there, what that looks like. I'd love to get your take on that.
Yeah, I think that we have to be very clear and separate and know kind of effectively where we are in this technology cycle, because the building out of the infrastructure and the capacity to fuel a technology can have very different winners than the actual application of the technology.
That's right.
Look at that happened in the 1990s, and then the ultimate winners ended up being those Mag 7 names, those internet names that certainly benefited from the early stages of the tech bubble. But the point was that they were very different than those that were putting up earnings in the initial stages of the tech bubble in the 90s. I think one of the fascinating things as we look at the Mag 7 today is that, yes, we can isolate those areas that have come directly from the application or the selling of AI CapEx into the market. NVIDIA is the best example of that. Certainly all of the upside and growth has come because people need the semiconductors to build these AI data centers. But the other point is that a lot of the upside in earnings growth, and it has been extraordinary earnings growth in the Mag 7 versus the rest of the market since the lows in 2022, a lot of that has come because these companies have benefited from a strong economy. They haven't added a lot of new headcount. In fact, in many places, they've been cutting headcount. So you've seen effectively these monopoly businesses finally look in the mirror, say, oh, wait, we are monopolies, raise prices, not add any new people. Maybe that's because they're applying some AI tools. And that has led to what has been super normal earnings growth for these Mag 7 names over the last 3 years. So when we think about, is AI in a bubble, you look at valuations, you go, no, valuations are not as extended on an absolute or relative basis as we've seen in prior bubbles. But if you look at the earnings that have been delivered by names that are trillion-dollar market caps that have grown earnings over the last 3 years by 250%.
It's impressive.
It's impressive, but it's also unprecedented. And I think that the margin expansion that we've seen, they've added 10 percentage points of margin expansion in the last 3 years. All of that suggests that, these are monopoly businesses. And I think the question is, will they remain monopoly businesses in a world where AI is starting to make things more competitive between them?
Well, you raised two kind of sub issues there that I think are really interesting. So one of them is you made the point that these Mag 7 companies are hiring fewer employees than they did in the past. I think there could be some interesting labor market implications from that, and from other behavioral changes that we've seen. But I'm curious to get your take on that. And then the second thing is, when you think about the S&P 500 and you think about its total performance, there's this concentration in the Mag 7. And I'm curious if you think that concentration broadens out to other areas of the S&P that maybe are a little less rich in terms of multiple, but still offer some growth potential.
One of the questions that keeps coming up with clients is it time to bet against the S&P 500? The S&P 500 has become an incredibly concentrated index. You are now at concentration levels. I believe the stat is 35% is the top 10 names. Could be higher. Don't quote me on it. Usually I know my numbers.
40, but it's something
it's gone up significantly. And we know history tells us that peaks in concentration, they can go longer and get higher than you think. But when they start to unwind, it can have important implications on broader markets. You can see obviously massive leadership rotations. Look at what happened in the 2000s, of course, where you had the tech names really underperform, value, small cap, international outperform. And you also typically see a lot of valuation compression. So just because markets are concentrated doesn't necessarily necessarily mean to be uninvested. It just means that just owning the largest ETF and closing your eyes and waking up in 10 years and having great results may not be as easy today as it was 10 years ago. So we're not at the point where we're arguing that investors should just be equal weight S&P 500. If you look equal weight, we bring it back to first principles. It's earnings. It's kind of like James Carville in the 90s saying it's the economy stupid.
Stupid, yeah.
It's earnings stupid. If you look at the equal weight S&P 500, which is an index that instead of you putting things at the market cap weight at the size of the company,
weight, total weight average,
everything is the same. So it reduces the concentration of the index. If you look at that, you actually are still cutting earnings estimates. So until you get into an environment where this is a broad-based market enough to be able to, and broad-based economy enough to support earnings estimates going up for the average stock, then you're likely still in an environment where the concentration can actually get more exacerbated. But there will come a time where betting against the concentrated market will be the right call. But you could have had qualms about the concentration at the start of this past year in 2025. You could have had qualms about concentration in 2024. And being early has been the equivalent of being late. So that's why we still bring it back to that discipline of where are earnings forecasts going. On your question about the labor market and AI's impact, I think it's interesting. There's a lot of debate as to whether or not we're seeing any evidence of it show up yet. And the one piece of evidence that people point to the most is the lack of hiring for college-age graduates. The problem is you typically see a lack of hiring for college-age graduates cyclically as you are in the late stages of a cycle. You don't need as much grunt work. You're trying to do more with less, and these are very unproductive workers. Typically, they have a lot of time to come up the learning curve. Of course, you and I probably were not unproductive workers as college-age graduates. It's like Lake Wobegon. We were definitely above average.
We'll definitely have to call my first boss and ask him. See what he says.
We can certainly do that. But I think the question is the weakness that we're seeing in that cohort of the labor market reflective of structural issues going on with AI, or is it reflective of cyclical issues going on with the US labor market, where we have seen it slowing around the margin pretty consistently for the last year and a half effectively? And we've not been at a point where that has translated to a significant jump higher in unemployment. Unemployment is still about 130, 140 basis points off of its lows, but you're not at a point yet where the labor market is falling off a cliff. That's going to be the key question for 2026. You're sitting at a 4.6 unemployment rate. Does it go lower over the course of the year because we have a global reacceleration, or does it move higher because we still have this kind of slowing growth pace in the economy?
Do you ascribe at all to the school of thought that there was labor hoarding during COVID, and that's part of the sort of cyclical nature, that now that we're out of that element of the business cycle, maybe part of what we're seeing in the labor market is less hoarding of labor? Do you think that's accurate?
I think so, because we could see it in the different surveys, like the Conference Board survey, where people were asked, is labor shortages or the access to labor the one of your biggest issues? And that remained elevated for quite some time. And that was likely one of the reasons why job openings remained elevated for quite some time, much higher than what people were expecting. People expected job openings to fall much faster. And so we've been in this environment that has been well appreciated to be a no hire, little fire kind of environment, which speaks to this idea of maybe it is just people moving away from the old behavioral economics recency bias of COVID to say, okay, well, I don't need to backfill the hiring as much, or I can let people leave the company through attrition. But we're not quite seeing a big uplift in large firings that would say, from a cyclical standpoint, companies are looking to the labor side of things in order to be able to save costs. I would say, though, I would make the argument that the reason why we've seen such a slowdown in hiring over the course of the last 9 months or so is likely because companies have borne the majority of the costs of tariffs. If you look at the breakdown of the tariff costs, who's paying? Some is getting passed into consumers. Very little is getting paid by the exporters. It's mostly the companies that are absorbing it in their margins. So if you can't raise prices that much, you're looking for other ways to cut costs. One way to do it is to cut labor costs. And I think that's the reason why we've seen this slow down. If you want the case in point for that, look at manufacturing jobs added over the course of the last 9 months. They've been negative ever since April.
The ISM data today were really weak too.
Yeah, I mean, it's hard with ISM because this is the Institute of Supply Management, the Purchasing Managers Index, and it's just a way to capture manufacturing activity. And below 50 is in contraction. And we've been in effectively contraction since 2022. We've had a couple blurbs of higher activity, but the ISM hasn't captured any of the activity that's gone on. You look at manufacturing non-residential construction, it has been effectively in a boom the last 3 years, and the ISMs haven't captured it. So I'm not one to call an index broken, but it's a harder index to use simply because it's been telling you things have been in the doldrums. But I used to cover industrials as an equity analyst, and one of the things that used to have a strong relationship was ISM and industrial earnings. That relationship has completely broken down.
The correlation isn't there anymore.
It's not there anymore.
Yeah.
Industrial earnings are great, but the ISM has told you that the world's been ending for 3 years, and it has not ended quite yet, as far as we can tell.
I mean, to your point, the ISM definitely has given us some false signals over the last couple of years. But I wanted to pivot a little bit. You've talked about us being in an environment that you've called stagflation light. I'd love to know what your definition of stagflation light is.
Yeah, so what we were arguing is making the difference between stagflation heavy, like Bud Heavy, in the 1970s, which was rising unemployment and rising inflation, rapidly rising inflation. We said, we think that the labor market is not going to get much stronger. We don't think it's going to weaken substantially. We think growth is going to be middling, but real growth is not going to be negative, for example. And we expected inflation to not accelerate, but remain sticky, which just means you're in an environment where growth is maybe sub-potential. That's hardly the case. I mean, look at third quarter GDP. I mean, if you wanted to say you've been wildly wrong, you look at third quarter GDP, it printed at nominal 8.2%. That's not a light environment for anything. That's very robust. But the argument was that effectively you weren't going to see the kind of disinflation that would make this old Fed, the existing Fed, able to cut rates back immediately to neutral because of that stickiness of inflation. We see that now. They are still concerned. And that the growth picture would be a bit of a muddle through, a bit of a below trend kind of growth. And that's where growth is surprised to the upside. You've seen revisions higher. People expect over 2% growth in 2025 and into 2026. So, maybe we just get the deflation, not the stag part of it, but the light still very much is in play.
And what do you, so when you have a customer, client, retail client, someone or an advisor who comes to you and says, how should I think about the optimal balance of my portfolio in 2026? And I'm not naive. I realize that every person has different individual financial circumstances. But if you had to think sort of on average, what would good market exposure look like in 26? What would you recommend?
So there's a lot of points to that. And the first one is that it is very customized and that everybody's liquidity needs, risk tolerances are different. And so it's really important to take all of those details into account before jumping to the conclusion. We always do a lot of wealth strategy work with our clients prior to even touching an investment allocation, because we have to know all of those details before we can even get to that point.
Important, incredibly important.
And it is because, it's not about this shiny new product or this shiny new opportunity, but really saying what are the goals we are trying to accomplish and what is the most efficient way that we can get there by taking the effectively the least amount of risk. As we look into 2026, I think that one of the things that we're talking about with clients is saying, Look, diversification might have felt really painful over the course of the last 15 years. We've been in a very one-track market. And you think about everybody's, probably everybody listening to this has at some point seen an asset allocation sheet that effectively looks like a check of the box that we need, large cap and mid and small and international and our bonds, mostly investment grade or munis and high yield and maybe, more and more so these days, some alternatives. And this kind of setup of an allocation, it has a lot of merit over the long run, but the reality is that you've seen markets be so concentrated, as we were talking earlier, that if you literally just bought the QQQs, boy, have you had a great time.
I mean, you did very well.
And nobody would want to be that concentrated because nobody has a crystal ball. But I think that we're starting to see a little bit more divergence where look at 2025. International really outperformed the US. There are opportunities to find ways to not necessarily bet against the market through diversification, but to make sure that you are not overexposed to one factor and one risk. And that really gets to the point of making sure that, and this is one of our main core mantras, which is know what you own and why you own it. If you don't know what you own, meaning there's a lot of uncertainty and it's a very complex solution or whatever is, that's a problem. But if you don't know why you own it and the role it plays in a portfolio, that's an even bigger problem.
That's why we call this straight to why. The why matters.
Yeah, exactly. And so one of the ways that we've solved for the why is that instead of, people have heard strategic asset allocation, right? That's a term that probably anybody who has a portfolio has said, well, this is my strategic asset allocation. We instead talk about it as a functional asset allocation. This idea that every asset has a function in a portfolio, and that function, knowing what it is, the why, the straight to why, knowing what it is allows you to tolerate volatility when it is inevitable in certain assets. So we'll break apart and say, okay, you have your liquidity bucket, you have your income bucket, you have your long-term growth bucket, and then you have your resilience or kind of diversification bucket. And that long-term growth bucket, I think, is the one that's most relevant for us to talk about in this conversation, because that's where your equities fall. That's where a lot of your growth alternatives fall. And the important thing for that bucket is to make sure that volatility doesn't cause you to have long-term ruin. Because if you look at the long-term chart of the S&P 500, it's up and to the right. Yeah. And even if you zoom out, 2008 doesn't look too terrible. However, living through 2008, it was terrible. But the only way to crystallize 2008 into your financial future is to be forced to sell when the market is down 40%. It's the only way to make that hurt you in a market that continues to go higher. So if you can be in a situation where a long-term portfolio is not forced to make the decisions that would be bad for it in the long term in order to meet short-term liquidity needs, that's powerful. And that's where we make sure that that growth bucket is sized correctly with the liquidity bucket, with the income bucket, because it's all about having optionality, because volatility is inevitable. You cannot get away from it, but you have to be in a position where you can make volatility work for you versus something that we want to be able to run towards it versus having to run away from it.
I think that's a really good mantra. I love that. And it's so true. So I wanted to spend a couple of minutes on alternatives with you. Obviously, there's been a significant amount of private credit capital raised over the last couple of years. Private equity is in a different cycle. There's kind of a backup a little bit on the private equity side, but we're beginning to talk about secondary markets more and more in that space. And obviously, there are other assets that people are looking to today, whether it's Bitcoin, stablecoin. There are different derivatives of assets that people look to today when they think about their total portfolio allocation. Do you also recommend these alternative strategies, or do you generally think of them as being sort of more risky today?
Well, look, our clients typically can afford the illiquidity that alternatives carry with them. And that's the important first starting point, which is that can you put something in the portfolio where you're not selling at the wrong time because you need access to it? And so making sure that that's not a portion of the portfolio that you need for your liquidity, whether it's a planned or unplanned liquidity event. So that is step number one. But private markets have the potential for outsized returns because of asymmetries in information, as well as the ability in certain places to be able to isolate what we would consider to be manager kind of skill, meaning that they do something that not a lot of other people do. They're playing in more esoteric markets or not as concentrated or efficient markets, for example, and that can afford us outsized returns. But it's really important, when we think about that concept of know what you own and why you own it, that also leads into know what you're paying for. Because if you're effectively paying 2 and 20 for market exposure, you're better off just in public markets. You might not be getting the kind of statement volatility.
Or you go back to your ETF, right?
Exactly. And you might not be getting the statement volatility in private markets that you do in public markets, but know that that's, as Cliff Asmus has said, it's laundered volatility. But I think it's important that you really have to keep certain alts, make sure that they earn their place in the portfolio, because if they're just giving you beta kind of exposure, then should you really be paying such high fees for that kind of beta? The other important part of it is understanding that just because liquidity is offered in certain vehicles doesn't mean it's always going to be there. So a lot of these evergreen funds, perpetual vehicles have become incredibly popular over the course of the last 3 years. They've become incredibly popular amongst retail investors who have never really gotten exposure to these things in the past. And so we don't necessarily know if some of these vehicles are battle tested through a real market downturn, something that would look, it doesn't have to be the extent of 2008, but something that's more protracted than just the blip that we had in April of this past year. Why is that important? Because the liquidity feature that is part of these things might give people the comfort to say, I can sell anytime I want. But remember that usually it's kind of like trying to, in the good old days in New York, when you're trying to catch a cab on a rainy day, there were no cabs. So the liquidity won't be there likely when you want it most. So that's where you have to still come back, is treat this as an illiquid asset in the portfolio. If you are comfortable with its illiquidity, then you can start talking about the incremental return that it could provide or the diversification that it could provide, depending on what kind of strategy it is.
That makes a lot of sense. Actually, Samara Cohen from BlackRock was on this podcast, and it was one of her main points as well. Right? That actually, in certain instances, selling out of the position is the hardest piece of work. And you can imagine that in a normal market environment, when selling out of a position in, let's say, Bitcoin or stablecoin is challenging, imagine in a downturn when everyone else is looking for the exits too, or for liquidity.
Well, and it is the harsh reality that there are times when correlations go to 1. And just because there's not statement volatility that reflects that one correlation in the alternatives, be darn sure that if you were actually going to try to sell at the time when things are correlating to 1, which means a period of higher market volatility, that you would experience that volatility in the realized value of the asset. So, I think that the biggest thing is for us is making sure that clients are really well educated about what they're investing in, and that the expectations are set properly, because we see a lot of people saying, and hearing from client or from peers that are very new to these markets, where they say, I can get something like private credit, we can get equity-like returns with bond-like risk and like,
some income maybe.
and it's like, okay, yes, you can look and the correlations have presented that way, but or the returns might look that way on the surface, but you really have to be disciplined about how you get invested in these things, and it's a decision that has to come with the awareness that you can't sell out of it tomorrow. So you got to love it, and you got to do your work in underwriting, which is why it's important our team on the alt side of things continues to grow and grow and grow, because we think that doing the deep due diligence on all these strategies is so imperative for us to have the confidence to put them in client portfolios.
Makes a ton of sense. Okay, so I want to shift to something fun. This is a lightning round, and I would love it if you could give me maybe 1 or 2 word answers. First thing that comes to mind, if that works for you. The first lightning round question is the following: trend to watch in 2026.
Unemployment rate, 100%.
100% agree. One word to describe markets in 2026.
Plot twist.
Ooh, I like that. Greatest potential areas of surprise or uncertainty.
Energy prices.
Okay, totally. Well, Venezuela will have an impact on that as well, although the markets are shrugging off some of those geopolitical risks so far. Best piece of investment advice. Know your why?
Know your why. 100%.
I love
This
that.
is where we are.
I love it. I might have fed you that answer. Is
Oh,
that
yeah,
really
that's
your
good.
real answer? Okay.
It definitely was. You led the witness, but yes.
I did. I led the witness. Biggest investment mistake to avoid?
Selling when you're scared and not buying when you should.
Okay.
My favorite book is Walter Deemer's When It Comes Time to Buy, You Won't Want To. It's just a bunch of his really pithy quotes, but it's fantastic. I think he just re-released it, and I keep it by my desk because when things get squirrely, you need that reminder.
Okay, I think I got to look that one up. I haven't read that one. Okay, I love that. So it's obvious to me that you're incredibly passionate about markets. You're an expert. You run deep in your business. You understand the metrics, the data, the markets. You understand what you're talking about. Where does this passion come from?
Oh my goodness. First, I think I have the coolest job in the entire world. And I know it's trite to say that you pinch yourself, but I really do pinch myself because I had the great fortune of studying economics at Rollins College, and I look back on the study of economics as being the most beautiful of all the liberal arts. And hear me out on this.
I know I'm with you because I was an econ major too.
So we're kindred spirits, because if you think about it, economics is the only liberal arts discipline that actually takes from all the other disciplines. There's psychology, there's history, there's mathematics, there's sociology.
Strategy, statistics.
Like you go on down the list of pretty much every single liberal arts discipline. There's a bit of it in economics, because economics is the study of the human experience and how we make decisions and how we live. How do we survive in the world on a day-to-day basis? And finance is effectively applied economics.
Yep.
So for me, the most fascinating thing is that you can never know everything in this industry. Not that you could never know everything in any industry, but you're always being humbled and having to get up to speed on different topics. You try not to get up to speed too much on social media. You love over the weekend with geopolitical. Everybody's now a heavy sour crude expert on Twitter or X. But the point is that it's impossible to get bored. And it's an honor to be able to work in an industry that I know so many people find fascinating as a hobby or something that they're interested in. So to get to be in the thick of it and get to have a voice in it is a dream come true.
What a note to end on. Cameron, thank you so much for spending time with us today on Straight to Why. I really enjoyed our conversation.
Thank you for having me.